dramatic pause. How are we all? Good evening. Welcome to our Stanford brand market update with Australia's answer to Warren Buffett and Charlie Munger all rolled into one. Our most mercurial Chief Investment Officer, Ashley Owen. Welcome, Ashley. My name is Vincent O'Neill, and for those of you that don't know me, I'm the CEO of Stanford brand. And before we begin formal proceedings tonight, importantly, a welcome to nation. I'd like to acknowledge the traditional owners of the land on which we meet, the Gadigal people of the Eora Nation, as the traditional custodians of the place we now call Sydney. I'd like to pay my respects to the elders, past, present, and future, and respects to all the people here today, wherever you may come from. Welcome, of course, to our many clients, but also to the friends and colleagues who may be joining us at one of our events for the first time this evening. In particular, I'd like to single out those of you who have introduced friends or colleagues to Stanford brand in the last year. We've been very fortunate in recent times to have a lot of trusted introductions, and we truly appreciate the vote of confidence that you provided to us. But more than anything else, we greatly value your ongoing support. Rest assured, that's not something we ever take for granted, particularly as a business over a period like the last 12 months. In fact, it's almost 12 months to the day since I last stood in this podium to introduce Ashley, and that was our last client event. Within almost days or hours of that evening, the COVID had started breaching northern Italy, and within weeks Europe was shut down and subsequently the world. And 12 months on, as we enter 2021 and move on, the pandemic still casts a long shadow over our lives. However, we move forward with optimism, and we plan for a year where we will rebuild and reunite. And what do I mean by that? On that note, Stanford brand wants to plan for more in-person events over the next 12 months. We've really realized, the Zoom screens, the webinars, there was a bit of a novelty there, but let's be honest, we all got a fair bit of fatigue quite quickly. And I know as an advisor, when you were meeting with clients, doing it over Zoom screen, it had certain efficiencies and you could probably cram more into your day. But it was never as personal, probably never as meaningful as what you did in person. And that's why we want to have a real focus on getting back to in-person events over the year ahead. Now, true, we definitely deal with a lot of uncertainty. And it is possible that you could say, well, an event like tonight, should we plan it? Should we plan to hold it? It takes a couple of months of planning. And at the time, New South Wales was still, unfortunately, had plenty of cases going at the time. But we decided, let's plan for the year. Plan to be able to hold the events. And if something should happen in the interim that doesn't let us do that, then we adjust accordingly. So you can look forward to this being the first of many events over the course of the year. Market updates, we plan some intergenerational wealth events, some retiree-focused events around spending and other things of that nature. And we look forward to rolling all that out to you over the weeks and months ahead. Ashley will be speaking tonight for approximately 40 minutes. Not 80, 40. Before opening up for a bit of Q&A. You're then invited to remain afterwards for a drink, a bite to eat, and an opportunity to debate further some of the questions that we raised tonight, and there's many of them. Before introducing Ashley, I would like to share some news with you. We are very excited this month to launch our tailored Stanford brand personal wealth app. It's a portal that allows you to link all your finances and bank accounts and property to superannuation and more. It keeps you up to date with the live data and help you track and store your entire financial world. It's also got an inbuilt digital signature tool to make it fast and easy to do sign-offs rather than the traditional post it and mail it scenario that takes a lot of time and wastes a lot of paper. Very enthusiastic, we'll get you signed up quickly, don't worry. Let me be clear what we're hoping to achieve with this. This is not part of a broader move to depersonalize our offering. We are very crystal clear in what we do. It is a personal service to our clients. It is very much about your personal relationship with your advisor and their support. And this is designed to be something that makes life somewhat easier. It makes it easier to find the information that you might want. And it's another way to share things rather than necessarily through email, which is these days quite spam-ridden. And unfortunately, from a security perspective, not safe whatsoever. Our job will be to roll this out in stages over the weeks ahead. So you can be talking to your advisor about it. However, For those of you that are keen, like the group at table 12, let your advisor know and we can get you set up and running ASAP. Now, on to the main event. Is the new normal real? Market optimism in recent months has been fueled by prediction of an end to inflation and a new normal, or as Ashley would describe it, the new normal, because I think we're on to about our fourth version of the new normal, for interest rates. Can we really assume a zero interest rate outlook forever? Can the debt-fueled asset price bubble last forever? Where do we then find income? How do we protect against risks? What about GameStop? Bitcoin? Gold? Tonight we cut through the noise to focus on the questions that matter for client portfolios in 2021 and beyond. So in introducing Ashley, I'd like to just give you a little bit of background. In a career spanning 34 years, Ashley has held several senior executive roles at Citigroup, HSBC and ANZ Group, who is responsible for a variety of national functions including lending, credit, branch operations, financial control and strategic planning. For the past 15 years, he has focused on investment markets, and prior to joining Stanford Brown, he spent 5 years advising and managing over $4 billion in client portfolios for a major independent advisory group, beating all their benchmarks over that 5-year period. Ashley, in his spare time, holds a degree in economics, history, law, and finance, is a CFA, charter holder, and he also has written 3 books on financing and investing, lectured in capital markets for the Securities Institute of Australia, and lectured for the CFA Society, Sydney. If that's it, I now hand you over for the next 40 minutes to our wonderful Ashley Owen. Welcome, Ashley.
I've seen some new faces, a lot of faces from previous year. This exact Thursday last year, last Thursday in Feb, I said, look, I'm going on leave, which I never do, but I did. So I'm leaving you in charge for 3 weeks. Next day was Friday, which was the top of the market, and it went straight down 37% from that day over 23 days. That's the last time I'm leaving you guys in charge of the market. No more leave for me. I hope you can see, we've got a bit of a long, spread out COVID-safe environment here, so we have all this in hard copy. We can send it to you tomorrow. We'll try and cover all of the things. I did a whip around of advisors and what are the hot topics and what are my emails look like every day. I get emails about Bitcoin and gold and China and are we in a bubble? I'll try and use this and see how we go. Yes, it works. Debt, we've paid off. Everyone's running wartime debts and wartime deficits. Inflation, everyone's talking about inflation now. They thought it was sort of solved 6 months ago. Interest rates, 0 for years. The Fed's promising interest rates 0 for 3 or 4 years. The RBA here is taking along, as it happens to do. Promising rates will be 0 for at least 2024. Bitcoin, gold, all those things. Where do you get money for yield? So I thought that pretty much covers all the issues, I think. I thought rather than that, let's talk about melons. More interesting than other stuff. So we're going to talk about melons, and we'll get sick of melons after a while. There's a melon as proof that we have actual melons here. One cost me $5.95 about 3 years ago, very expensive. So we're going to talk about melons. Sorry, not that one, that's not a melon, that's a pumpkin. Janet Yellen. Very important, her name will pop up a few times. She was Fed Secretary under Obama, did the best to create inflation. Fed Chair, sorry, now she's back as Biden's Fed Secretary of Treasury, so her aim in life is to create inflation if it kills her. So that's an important, that's actually a pretty good shot of her. Or yellow. We're in a bubble, and every asset in the world is bubble-like and over-expensive, extremely expensive in a lot of cases because of Yellen and her ilk. And selling, Melon Yellen and selling. Now it could be selling from this guy who's selling it to you. We'll meet a few of these tonight. That's not really in a bad suit. That's actually a used car salesman, probably in Brisbane, since most of them in Brisbane. Apologies to the Queenslanders here, or Gold Coast. Or panic selling. So melon, yelling and selling will come up a lot. So why melons? Now, we're talking about GameStop and Bitcoin and gold and a whole lot of other things. I like making daiquiris, and I make daiquiris with real fruit. And the daiquiri, you need, of course, Cointreau, white rum, and real fruit, which you then blend up and put in the freezer overnight and drink. If it doesn't come out the right formula, you change the formula and keep drinking until you get the formula right. It's quite good, but you need real fruit. So I went to the market to buy melons. This is not this one, but when I did this, I first had this idea. And of course, the market's all out in the sun, and they've got little stalls and these guys and women selling things at the back of the truck. And they start off in the morning at 4 a.m. and they get busier and busier as time goes on. So you look around for fruit, to find a melon or a tray of melons. So there's a tray selling for $15 a tray, which is actually not bad, given they're about $5 individually. So a tray of melons is about 6 or 7 melons. And the sun comes out, and they're the only seller, so they're selling at $1 a kilo, which is about the going rate. And then the next guy pulls up in his truck and unloads another load of melons, and there he's now like double the supply. I've got to actually reduce the price, so it comes down to 90 cents a kilo, 80 cents a kilo, 70 cents a kilo. At which point I'm saying, not bad melons, I'll buy some of those at 70 cents a kilo, not bad. Another truck pulls up, another store goes up, more supply, less demand. Sun comes out, people go to the shade, 60 cents a kilo, not bad. I'll buy some of those. So I bought the melons. Or what could happen is, all of a sudden, a whole lot of busload of tourists come in, or somebody from somewhere wants a bunch of melons, it's sold out that tray, all of a sudden the demand exceeds supply, and the price goes up to $1.50 a tray, $1.50 a kilo. So the price goes up, at which point I say, well, I know what a melon is, $2 a kilo is too much, I'll go and buy something else, I'll go and buy peaches, make a peach daiquiri, not bad. Or similar to blueberries, I buy blueberries twice a week, pretty much all year, and they can be $2, $2.50 a punnet, or $9 a punnet or more sometimes, some cases. Now in your mind you've got an idea of the value of blueberries on breakfast, so well it's worth, I'm not going to pay any more than $6, $7 a punnet for blueberries, so I can always buy strawberries instead because they're a different season. So if blueberries get down to $3 a punnet, I'm going to buy blueberries because they're cheap. The cheaper they go, the more I want to buy. If they go to $9, which is off season, I say, I don't need blueberries after all. So that's the difference between, that's what you do when you're buying a melon. You know what it is. It doesn't produce cash, doesn't make a profit, but you know what it is. You've got an idea of value. But at least you say, well, I've got an idea of value. If it's more than that, if it goes up, I won't buy it. If it's going to come down, I'll buy it when it's down. If it's cheap, if it's getting cheaper because a busload of people come in and they start selling more melons, I'm going to say, well, I might buy 2 trays, make 2 buckets of that. That's what every one of us does when we see a house or a share or any business or a property you want to buy. You put a value on it in your mind, whether you sit down with a calculator or not, doesn't matter. You put a value on it, and if it's cheaper in the market than the value, you say, well, I'll buy 2 of those. If it gets more expensive, you say, well, there's a point at which I'll buy that. It's expensive, I'll wait till next month. Once in a lifetime deals come along every month, is one of my sayings. So I've bought a lot of properties over the years, well, sold a lot of properties over the years, but basically once in a lifetime deals come along every month. If it's above the price, you say no, never buy at auction, never bid the last bid at auction, always go and negotiate after auction, always offer lower than you paid than the last bid. And if they're desperate, they'll sell, which is good. If they're not, wait till next month. Anyway, that's buying melons. We know what it is, we put a value on it, we buy it. Bitcoin, which we'll cover. The reason for telling this story is this. When Bitcoin drops 20%, which it did yesterday, I got no emails this morning about Bitcoin. Because the interest is only raised, you only get questions after it's going up. So whenever you're buying anything, ask yourself, are you a speculator or you're an investor? If you start asking questions and getting carried away and excited after the price has gone up, it's like jumping in and buying more melons when they're $7, $8. It's ridiculous. You're only buying it because some fool's going to buy it off you, the hope is, at some other price. You're only buying it because it's gone up, and you're hoping that'll continue, and you'll sell it to somebody else who's a bigger fool. The bigger fool theory. It's always a bigger fool. Somebody can take it off their hands. If, on the other hand, Bitcoin's falling, as it did for 3 years, it peaked in 2017 and came down a pretty straight line, down for 5 years in a row, pretty much 3 years in a row, you heard nothing about Bitcoin because it was going down. If it was a value, people would say, hang on, I reckon it's worth $5 or $5,000. It's now $4,000. I'll buy some. But it's not. You only get interest, emails, questions from advisors, questions from clients and third parties saying, what about this, what about that? If they're doing it because the price is going up, you know it's speculation. If you're doing it after the price has gone down, you say, well, let's see, it was $1,000 yesterday. It's gone down, 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 down. It was 5,000. Maybe it's good value, or maybe it'll go to zero. So it's how you think about an asset, whatever the asset is, will tell you instantly whether you're a speculator or investor. Now, there's no harm in gambling. I've been to probably a dozen Melbourne Cups. I used to live in Melbourne twice. I've been to other events where there's gambling. Nothing wrong with that. As long as you know when you walk in, you're gambling. A bit of fun. Nothing wrong with it. Harmless. With money you can't afford to lose. You can afford to lose. But that's gambling. We know it's gambling. You know you're having a punt on the horse or whatever it is, but you know it's gambling. As long as you put a different hat on between gambling and investing and separate the two. So when we get the bubbles and busts all the time, think to yourself, am I an investor thinking about this, or am I a gambler hoping to sell it to somebody else at a higher price? And that'll tell you how to approach it. We'll deal with Dylan at great length. We'll see a few of those. Not much has changed really since last year, has it? I'll put this down somewhere. For diversified sort of cautious investors, which is us, shares are up. This is from the start of last year when all the excitement happened. Shares are up around the world, in Australia about 5, 6, 7, 8%, give or take. No big deal, as expected. Bonds are up a bit now, 1, 2, 3, 4%, which is good. Low inflation. Bonds are going to give you a few percent return, which they did. Aussie dollars up a little. Good. Commodity prices are up. Dollars up. No big deal. It's not like up 20% or down 20%. It's up 3, 4, 5%, which is pretty stable. Housing up a little, depending on where you are. So basically, point to point, not a lot changed. So if you're in a diversified investment portfolio, you're going to have earned over the last 12 months, 2, 3, 4, something in that order, some low single-digit number. So there's all the asset classes. By the way, there's some sort of letters in wording that's small. The idea is that the risk assets are at the top, shares, bonds. The only one that hasn't come back is commercial property, which we're out of. We don't have any of that because we always thought it would perform poorly in the post-COVID environment for a whole lot of reasons. We won't talk about that. But share markets, emerging markets, Australian shares, developed market shares, they're all up by single digits or so, pretty much a standard year-ish. Bond markets, this is the high yield bonds which collapsed but they've come back slowly. This is government bonds, this is high rate bonds. The red dotted line is the cash rate which has fallen to zero. But by and large, point to point, it's been a pretty boring year. Unfortunately, that's not what people are talking about. People are talking, everyone of my friends, I know people, family even, unfortunately, all of you have friends and family who did one or two things. Got 100% on something, insert bubble here, some tech stock or lithium stock or something, or they lost everything. Unfortunately, a lot of people lost everything. A whole lot of things, a whole lot of reasons why over the last 12 months, which is the same as every year, but this 12 months flushed out a few more scams and scandals. So whereas we talk about returns of 0.5% and 3% and 2%, all of which is very boring, everyone out there, the headlines are full of 1,000% return, and there have been some, or minus 100% returns. Lost a house, lost a family, lost a business, lost everything. More so if they geared up or had a margin loan. So we're dealing with extremes, people making hundreds of percents or thousands of percents, which gets headlines. And some of us know people who've got that. And the other extreme, people lost the house, lost their savings, lost their entire net worth. All sorts of things we're going through. So they're the extremes we're talking about. Now, none of those are investing. They're gambling at both ends, and we'll talk about that. That's the same as gambling, the same as the melon. So if we do a nice little chart, this is potential returns, thousands of percent or 100%. This is 100% loss. You never get your money back. This is zero. Risk of permanent loss of capital. Bank TDs pay about, if you're lucky, 0.5% maybe 1% for some long-term TDs. Cash pays 0. So that's no risk of loss, of course. You won't get the government guaranteed, but you've got no returns. We are here. We sit in our diversified portfolios, all of our long-term money, whether it's conservative growth, high growth, it's pretty much very stable, sound, reliable. It's designed to get you to your long-term goals, the capital income you need for the rest of your life and your family without too much worry. Sleep at night. We're not going to make 1,000%. We're not going to lose 100%. So the aim is to provide good, real, solid growth, cash flows for the rest of your life and beyond. So it sits in that sort of area in the market. Very boring. Don't get any headlines with that. Unfortunately, people are talking about Tesla, and Tesla was up 700% last year. Fiverr, which is a little app, around up 700%. Novavax, which is a vax thing. Tech thing, 2,700, this is an American company. NVIDIA, which is your gaming software, which all the kids play games with, that's up 1,000%, 100%. Chinese stocks, BYD, the car company, NIO, some of those little social media stocks that are up 100%. Aussie stocks, there's some stocks there that were up 26,000%. And I know somebody who actually bought Chalice Mining, which is a little gold mining speculator stock. No profits or dividends anywhere, so it's speculation. But good luck to you if you can do it. That's not what we do. But this is what gets headlines. People are saying, why didn't I get that? Why didn't I? Well, because you've got a diversified portfolio that's going to be there for the rest of your life and your kids. That's why you're not going to get 1,000% return. Nor will we blow it up. You've got some other ones. You've got your game stocks. We'll talk about those if we have time. Now, it depends. Now, one of the guys was saying GameStop was up 100% last night in the US market, which is fine because it's down 95% where it was at the end of January. Now, if it's down 95%, it was gone from whatever it was, $550 to less than $100. It's doubled overnight. You're still 90% down on what it was that you bought at the top. So it depends on where you buy these things. Now, I don't want to spend too much time, but if you've got questions, I'm happy to go through those BlackBerry nuggets. These are all the short squeezes. So they give up there. The problem with that is that's not investing. That's just speculative. There's nothing wrong with that. It's like going to the races. I didn't make up a casino. Well, not one of Crown casinos, good for license, but you know what I mean. It's a different world. We're not talking about that in the portfolios. We're talking about being there for when you're old and grey, which some of you might get old and grey one day. They rely on speculative fever. Those old enough, I lived through and did very well actually out of the 87 crash, the .com, the tech wreck, the GFC, post-GFC. I've been through all of those. And most of the stocks, headline stocks now, including those on the list, won't exist, or there'll be 1 cent a share in a couple of years' time. Happens every time. People say, oh, no, this time's different. It ain't different. It's got no cash, got no revenue, it's got nothing except hope and hype. It's going to be worth nothing. It's pure speculation. Good luck to you. Nothing wrong with that. As long as you do it with money you don't mind never seeing again. And I've had this conversation with clients many, many times. Say, look, we'll look after the bulk of the portfolio for you and your kids for when you're old and grey. Here's 100,000, here's $1 million. Go for your life. We're not saying don't do it. It's your money. Play with it. But if you lose it doesn't matter because this one's going to give you what you need in 20, 30, 40 years' time. Nothing wrong with it. But make sure you understand whether you're dealing with melons or bubbles. So the other thing I put on there is high yield fixed income funds, all sorts of things. Now the problem with those is they don't offer any more. Some of them offer sort of 5 or 10% return, fixed rate guaranteed for 2 or 3, 4, 5, 10 years. So it's not, you're not going to get 1,000%. You're maybe going to get 6 or 8%, but they still go to zero regularly, and you lose all your money, never get it back ever, worthless. So I put in there, I mean, if you're going to play speculation, you may as well go for these things, because at least you might triple your money, double your money, and make 1,000%, because there's always a big fool to take it off your hands, unless the market, the music stops. When the music stops, all bets are off, you've done your job. That's fine, but this is working for you. These portfolios, by the way, they're so safe, even the umbrellas have protection. Okay, so this is where we are. So this is, I don't want to dwell on this because this is a bit close to home in a lot of cases, but this is the sort of thing when you start chasing yield, somebody offers you 3, 4, 5% fixed term guaranteed. They're not guaranteed, they're guaranteed by a bankrupt property developer, $2 company, so it's not guaranteed. IPO wealth, you've heard about that. About $300 million was done. All those things up in Queensland, unfortunately. Term investments offering 5%, 6%, 3%. Alan Jones, 2GB, basically spruiked that for months and they're still doing it probably. I mean, the guy that's running that is still trying to raise a mortgage fund at 9.6% fixed for a year. The rest are all collapsed, they're bankrupt, but you've got a front. This guy, Gold Coast, unfortunately, actually no, it was King Beach, just below the Gold Coast. Really. 20% returns. He won the Asia Fund, which is Asia Head, which is a big Hong Kong-based firm that rates hedge funds. But fund of the year, straight fraud. Not even any pretense of investing. It's just pocketed the cash and run. No, they do that. They dress it up, great looking prospectus, 20% returns. It's all a sham. We don't go there. 5 months later, they promise 5%, 8% for 5 years. Big company, the Virgin household name, bankrupt 5 months later. They've got 7 cents on the dollar back for that. IG Group, a whole bunch of groups now. They had a powwow and said, "What's hot? Biotech's hot. Tick, we'll put that in the word somewhere. Ethical's hot. Tick, put that in the word somewhere." And they've come up with this idea of ethical biotech funds. Pure scams. A couple $100 million in those gone. They promised 9% for a year, 11% for 2 years. Sounds good. Guaranteed by what? Bankrupt $2 company. Guarantees worthless. There's some straight frauds, email frauds. One of them is called Citibank, which I worked for 20, 30 years ago. But this fund they have, and they made up this fund, they are promising 5%, 9% for 10 years, fixed by Citibank. Sounds good. Complete fraud. Nothing wrong with Citibank, nothing to do with them, but their name was used as a fraud. ASIC's got a website full of these. I've just got a smattering of that. But unfortunately, this guy here, my son went to uni with, unfortunately. He decided to go, he raised money, he delivered, claimed 2,800% returns in 2019. Off the back of that, this is all public, it's all PDS, it's all prospectus. He raised $90 million. Complete fraud, just stolen. Not even a pretense to run a business. Anyway, hold on. Friends are friends. Unfortunately, I know somebody who knows who didn't give her any money, but it's easy to laugh about it, but I know people, friends and family, GFC, same thing, lost the house, lost the business, lost the family, lost the farm, never get it back ever. And they've got to start again. So it's dangerous stuff. None of these, apart from this guy here who promised 2,800% return, these other things, they were just sitting in the space here. They're already promising 5, 6, 7, 8, 10% return. But with zero rates at the RBA, you say, well, how hard can it be? 5%, I'll take that. You'll never see the money again. Now, it's not guaranteed, of course. There's some are. We spend a lot of time researching these funds and recruiting good ones. But the ones that are straight shams and frauds, they're dressed up nicely, they look good, they sound good, they're all the paperwork, it's very easy to forge stuff. But there's one out there. So, enough said on those, unfortunately. What we do for income is very different. We've always had pretty much no cash in portfolios. People say, oh, cash is zero, what do you do for income? I said, we've never had any cash in portfolios. We carry, I think, 3% for the platform minimum requirement for cash. But we virtually have no cash in our portfolios. We have most of our shares, for example, Aussie shares today, even at bubble prices, they're yielding 6, 7%, including franking credits. You can't beat that yield, best franking, best yielding market in the world. Now, yes, they're overpriced in a lot of the areas, but dividends in Australia were, ASX companies were about $83 billion 2019. That dropped to 61 or $2 billion. So it was down like 30% dividends last year, 2020. That's on track after the reporting season just gone, or in the middle of now, February. Probably that'll get back to around $74 billion across the ASX. That's not bad, given a 30% drop. Most of that's going to be recovered this year, and we haven't got the vaccine yet. We're still in lockdown in half the places. So Australian shares are not bad. They're not bad. We use high-grade fixed-rate corporate debt. It's hurt by rising interest inflation, which we'll see in a second. We'll cover high-grade floating-rate debt. High-grade means investment grade. None of this high-yield stuff. It has its place, but it's not a safe, reliable income-generating asset. So you're not going to get 5, 6%. You're getting 2, 3%. Better than losing the money. It's better than 0% on that part of the portfolio. And we're also adding some in the next month or two. We're going to add some other high-grade, very diversified, very high-yield, diversified fixed-term investments. So what did happen last year, even though investment markets are pretty much square, they are square because governments basically have become printers of money, lenders of last resort, owners of last resort, employees of last resort. Basically, the government runs everything. You can't wear different colour socks unless the government lets you. Last night, I had to record it and play it back. Morrison announced, I think it was 7:30 News, 7 o'clock News, he announced that from a date, Monday, whatever, lunchtime or midnight, from a certain date coming up, dancing would be allowed at weddings. Now, you laugh about it, but this is supposed to be a free society. We're actually happy now that the government lets us dance at weddings. It's scary, scary stuff. It's a police state gone mad. And the last year has made us so accustomed to and used to it. It's dangerous where they can take it now. The Australian government almost trusts. As you'll see in a second, it's actually one of the best government systems, not left or right. The government system is actually pretty much unbeaten in the world. A lot of countries, that sort of stuff is scary and it's going on under our noses. So it is just mind-boggling how governments have taken over the world. Massive government spending, massive government debt, so everyone's got a lot more debt. So this is a problem. Now, I've got 3 things here. I've got 3 each bar, and you can see Japan at the top, because it's been the highest debt country for donkey years. The 3 bars are 2007, immediately prior to the GFC. GFC was a debt problem. The solution to that debt problem was everyone's got to go more debt. So the second bar is 2019, prior to COVID. And the third bar is pretty much September last year. I'm still waiting for the December numbers. So you can see here, Japan in that case, it's gone from the highest debt country in the world, these are countries, to even higher, to even higher now with all the money printing and all the government deficits. Now you can see the 3 colours are, green is government debt, so in Japan's case, the problem is government debt. Monstrous government debt. I'll put it in context in a second. France, Canada, UK. In terms of government debt, Japan is far and away the worst. USA is pretty bad. Italy, Europe is pretty bad in general for government debt. The pink one is corporate debt, which in some cases is very, very extended. There's too much corporate debt in most of the world, particularly Europe, particularly America. Australia corporate debt, we haven't got enough corporate debt. I want businesses to borrow more in Australia. Businesses borrowing creates jobs, creates employment, creates things, creates economy growing. Australia, unfortunately, has the highest level of household debt in the world, in history, in any era of history, in any planet in the universe. Quite seriously, there's no civilization on Earth since we crawled out of the cave 10,000 years ago on any planet on this solar system or any other solar system. The level of household debt, that's how serious it is. So I'm always going to get a question about housing and how house price is going to go up, and then I can't avoid that, so I'll save that to the end. House prices are propped up by that massive pile of household debt. So basically what you see there is, firstly, every government's piled on far more debt than the GFC and the post-GFC spending and now the stimulus, which it's going to get a lot worse than that this year, next year. That's firstly. The second lesson is government debt is a problem in most cases, corporate debt is a problem in most cases, household debt is a problem in cases like Australia, but ranked according to most countries in the world here, most 90% of the population of the world. New Zealand beats us, of course, but we've only got 1 layer of government. We've got 3 or 4 on this count. There's too much government in Australia. India has no household debt because they've got no security of tenure. You don't own a house in India, so they've got nothing to lend on, so there's no debt. That's not a good thing. Household's a problem. Corporate's too low. Government's affordable. Now, this is a chart going back. This is one of my short-term charts going back to 1850. The blue line is business debt to GDP, which is GDP is the national income of the country. It got a bit carried away here and it got blown up in the Great Depression. The red line is household debt to GDP. People didn't own a house 150 years ago. Post-war, it rode up. Now, the tipping point was deregulation. Deregulation of banks in the 80s, household debt skyrocketed. The GFC had caused a big deleveraging of corporate debt in the 90s and deleveraging after the GFC. They stopped borrowing. Households just kept borrowing. So what's wrong there is the shape. That's too low. Banks keep lending. Banks are basically building societies with $10 million CEOs. Why housing? Housing requires less capital and no brains. That's what I was a banker 30 years ago. Housing, the lending on housing is very easy for banks to do. It requires the brainless twits. Well, they are. Banks don't know how to lend cash flow. Cash flow lending is what banks do. Should be. Banks, for thousands of years, have been cash flow lenders, short-term cash flow lenders to business. In Australia, they can't understand the concept of cash flow. They've got a house, it's easier. That's another story. But the problem is this one here. So that's not going to cause inflation or problems in markets. So that's a separate discussion for another day. What's going to cause problems in markets for all of our portfolios and all investors is going to be the next one, which is government. This is a little chart, my little short-term chart since Federation. This is government deficits, First World War, Second World War, post-war booms. This is the Keating, Howard Keating surpluses, which is good. This is the Howard surpluses, which is good. This is the Rudd deficits after the GFC, not their fault, that was the GFC. This is the single surplus we had in 2019 before boom. So this is the deficits we're going to spend. Wartime-like deficits. This is the net. This is the debt, total Commonwealth government debt. These are the golden years before Canberra, wish for those days again. Canberra came along, started to borrow money. Actually took over state debts. So this is the wartime World War II debt. This number here is less than Japan is today. It's very bad, but Japan is at that level. It just physically cannot grow to pay its debt. Japan's a dying country. Problem is here, we're running at wartime debt levels. It might be less than that, but this is my estimate of the next 2 or 3 years based on those deficits. Might be better, might be worse, but the point is it's massive compared to our history. That's important, but not critical. What's critical is, can we afford to pay the interest? So this is the same chart with debt, but this is the interest payment, the debt servicing of our Commonwealth government debt. So the point is, wartime debts, Australia was spending more than half of its total revenue on paying interest on debt. Today, even with the big blowout, it's probably going to be something like 1.5% of GDP. Why? Because rates are so low, they're borrowing at 1% for 35 years. Rates are so low. And yes, rates will rise, but a 35-year loan has the same rate for 35 years. It's only when you roll it in 10, 15, 20 years' time you pay more interest rates. So that low rate is locked in for decades, which will keep that debt servicing. So this is interest as a proportion of government revenues, which is about 5%, far less than it's been for the last few decades. And this is as a percentage of total revenue. So something like 1 or 2% of Australia's revenue goes to service the Commonwealth government debt. Very affordable, very simple. So people talk about the debt levels, but in fact in Australia's case it's very affordable, very low, and it'll be low for a long, long time. I get this question all the time, how are we going to pay it off? Now, households, businesses and governments are 3 different sorts of animals. A household's got to pay off the debt because one day it want to retire and live off the savings. So all of us back in my day, we worked, got married, had kids, paid off the debt and saved and retired. Nowadays, I run into people who retired and they've still got $1 million in debt. And the kids are still downstairs at home and they want the house. So it's a different world. But ultimately, you've got to pay off the debt if you want to retire. Otherwise, you do the Howard solution and work till you drop. So the answer is yes, you've got to pay it off. That's why that first whole household debt in Australia is monstrous, but it's got to be paid off sometime. Otherwise, you'll never retire, you work till you drop. Companies are not that same. Companies can go forever. Companies should carry debt. They should carry more than they're carrying at the moment, as long as it's productive and pays income. What you're building a factory or whatever you're doing with the debt produces income more than interest. Companies should in Australia be borrowing more. Long-term productive debt. They never need to pay it off, they're perpetual. Governments, same thing. They need to pay it off because a good government should be running a deficit. I've always said Australia had a lazy balance sheet until this year. But Australia, if Australia was a company, the CEO would be fired for running a lazy balance sheet. You're not doing that. Germany's the same. Germany's big on austerity. They're not spending any money. German roads have got potholes in them. German ports, German train stations are an embarrassment because their austerity has stopped them spending, which means they're not building good productive capacity. So Australia, it's fine, but only where your working population grows. Japan is dying. Europe is dying. We'll see that in a second. They've got big problems because they'll never grow fast enough to pay off the debt. Australia, young, growing country. Debt's good as long as it's exactly the same. So companies and governments are the same. As long as you're spending it on stuff, snow mountain skiing, roads, bridges, etc., which produces productivity, lowest costs, good for the country, it's fantastic. So they're the same. You don't need to pay off the debt. So we're not worried about Australia paying off the debt. It doesn't have to, as long as it services it. And currently it's got many, many years of very low debt service capacity ratios. So there's four solutions for paying off the debt or paying the interest on the debt. You don't need to pay it off. Pay or don't pay. Simple. Pay, there's three ways of paying. You can cut spending or raise taxes, the European, the German method, austerity. Doesn't work. It sends you back into recession like it did in 2011 to all of Europe. That's the Greek solution. You just keep, when they bail them out, they say, we can't let have toast with your breakfast anymore. So the austerity killed them back in, but it's just debt cycle, it's a recession cycle, given the austerity rules imposed by the structure. So it doesn't work, particularly in declining population, declining poor demographic areas like Japan, like Germany. Austerity, low growth, low employment, just bad. It's a cycle of debt. Never get out of that. Japan, Europe, they will default because they simply do not have the growth of that capacity. That's before they close the borders. Europe, the last thing you want to do. Japan, for example, is a declining population, declining workforce, declining taxpayer base. Somebody just switch off the lights. They're rich, and they say, well, what's the problem? Rich, which is fine, but they will never pay off the debt. It'll be solved internally by book entry. The pension, 95% of German debt, Japanese debt, is owned by Japanese pension funds, and they'll simply accept lower pensions. That'll be the way it's done. Europe is a little more complex. You've got 28 countries to deal with, but the same problem. Never ending debt spiral because Germany's in charge, more or less, with the austerity. You can grow, population growth, productivity growth, private sector business, or government. So in the case of Australia, there'll be some inflation, some rate hikes. Australia, New Zealand, US, Canada, which are basically pro-business economies and growing young productive economies. Government will be producing most of the growth in China and Japan. Doesn't China and India, it's India by the way. Not too bad, it'll work, they'll grow their way out. Or you can inflate it away, which they're deliberately trying to do, Yellen and the others. If you've got local currency debt, which most Western countries have, all of our Australian dollar debt is in Australian dollars. We don't have any US dollars. Emerging markets, Southern America, Africa, they all borrow in US dollars, so they're a problem because they have foreign currency debt. Different problem, different solutions. So I reckon UK will inflate its way out of debt. Other foreign countries, mostly emerging markets, you've got there Brazil, Argentina, Russia, that's Mexico. A lot of Chinese provincial government debt is US dollar based, and several provincial government or entities, SIVs, special purpose vehicles, have defaulted over the last 6 months, 9 months. They're rolled over by the government and they're hidden for a while, but that'll be a problem in a lot of provincial Chinese governments. But by and large, China will grow up. Now, their population will stop growing in 5 years, 10 years' time. But still, there's a lot of poor people they're bringing out. So a lot of productivity growth in China yet to come, even though the population's capped. Otherwise, default. Austerity conditions. So when you default, it's fine. Australia defaulted in 1931 on all its debt, restructured. Austerity was imposed. So that's actually quite a tough road because you restructure like Argentina regularly. The austerity imposed pretty much guarantees a cycle of default, particularly on foreign debt. Debt spiral. So a lot of countries, Greece is there, Venezuela's there. So the good news is that's most of the world there, apart from Europe and Japan, which are basket cases in terms of government debt. Most of the world in our neighbourhood is in this spot here, which will grow its way out. A bit of inflation, so you'll see rate hikes, you'll see some inflation and some rate hikes, but you won't see hyperinflation, you won't see defaults in these countries like Venezuela, Argentina. So the question is, the new normal, because I think PIMCO coined new normal in 2011. There are several forces, and this is by no means guaranteed, and it'll take a long time. It's not inflation that kills markets. It's rate hikes or fear of rate hikes that will be required to kill inflation. So in 2018, from December 2017 to December 2018, Jay Powell at the Fed raised rates in the US 4 times. And the market sold off. There's no sign of inflation, not runaway inflation, but the market sold off 25% in December 2018, including Australia, that quarter, because not inflation, was because the fear the Fed will just keep raising rates. It rose it to 2%. A fair cash rate for the US economy is around about 3 or 4%, which is terrifying. At zero now, it's like 20 rate hikes away. That's terrifying. That will cause major problems. So it's not inflation. It's the fear that the Fed will have to raise rates quickly and savagely, whether they do or not. It's the fear that they will that'll cause share markets to fall regularly over the next 3 or 5 years. A lot of false starts, like 2018. So the forces are, one of the great things in Australia's favour is we're entering this great Cold War, not great Cold War, but great meaning massive global, a bit like the 50s and 60s, military spending, budgets, that directly affects Australia with the books. Immigration is strong in Australia post-COVID. It's always been a very strong immigration country. Protection and self-reliance, idea of self-reliance, which Trump didn't start, but Trump sort of capitalised on. That's very inflationary because all of a sudden you can't use cheap imports. You've got to start making steel in America, which is expensive. iPods, the Mac Pro. Anybody got a Mac Pro here? Which is this new Make America Great Again. It's built in a factory in Texas. Apple, for Trump, built a factory in Texas, and they've produced the Mac Pro, which is the most horrendously expensive, badly made thing, but it uses American labour. It's expensive. They sell about 3 per year. It's a shocking thing, but it is strategically as a way to get manufacturing back into America. Not working, but it'll take years to work. As it took years in the first place. That's all inflationary, of course, because if that happened across the board, if China said, which it may well tomorrow, no more manufacturing, no more sales to the US, and no more importing rocks from Australia, then that's going to be massively inflationary for everyone else trying to buy a Mac Pro. Will suddenly cost 5,000, not 2,000. Phone costs 3,000, not 1,000. So that's inflationary, and that's already working through to steel prices in the US, for example, today. Monetary expansion, of course, the old favourite, free money, asset buying. So all these things, and when people say we're going to get inflation, I say there is 100% certainty of inflation rising. But maybe it will be 100%. Why? Because central banks who run the world have said we will keep doing it until we get it. We're going to do it until we do it. So that's it. On the deflation side, we've got demographics. The world is dying. There's no baby boom after the First World War. There's no baby boom after the Second World War, which created inflation, created jobs, created wealth, created activity in manufacturing. Are we going to have a baby? No. The world's going to stop at about 9.5 billion people in 20 years' time and stop. 100 years ago, there was a reason to have kids because they stayed in the farm and looked after the old. Nowadays, the kids disappear. They want their house, they want to disappear. So there's no economic reason to have kids anymore. We all know that. My grandparent, my dad was one of 10. I was one of 4. I had 2. My kids will probably have 1 if they're lucky. So the world is shrinking, and that is massively deflationary. There's too many factories and workers out of work. So there's just China's producing more stuff. So it's and German austerity, the whole mindset around Europe is very deflationary. So there's an equal number of factors working. I only put it on that side, by the way, because we're webcasting this now, and my little face appears on the screen. That's only which I've tilted the scales. But it's going to be. It's not a done deal. We're going to get lots of false starts, but inflation, serious inflation, is a long way away yet for most of the developed world. This is the long-term picture. Well, not long-term, 1870s. You can see inflation rising. Massive inflation, deflation, massive inflation. Now, the first lesson there is the global phenomenon. There's local variations, but it's pretty much a global phenomenon because of global trade. Globalization has created this and has done for hundreds of years. So it's very cyclical. There are lots of local variations. You can see, German hyperinflation off the charts in 1923. You can see Japanese post-war inflation off the charts post-Second World War. By and large, this is the 70s. This is the great deflation we've had in the last 20, 30 years. Here we are now, rising inflation. Main causes are monetary expansion, governments printing money. Why? To fund wars. Every war since the Peloponnesian War, Dionysius 401 BC, every war has been financed by governments printing money, which by definition and intentionally is inflationary. They want to create inflation to have more money to buy ships and buy cars and stuff. So that's always been behind these great inflationary build-ups. Monetary expansion primarily for wars. We're facing another situation where every country, including Japan, which is a big deal for Japan, building warships, building munitions. What with outlooks? China, Vietnam, Philippines, they're all building stuff for the next 20, 30 years. It'll be a great build-up. Great for our rock diggers. So inflation, impact on everything. So the first lesson to get a handle on is whether you're in the good camp or the bad camp. There's 3 sorts of people in the world. There's those who think there are 3 sorts of people, and those who think there are 2. I'm one of the latter ones. There's savers and lenders, and there's borrowers and spenders. We are all here savers and apart from a few people with lots of debts in the back, we are savers and lenders. Inflation is a transfer of wealth from savers and lenders into the pockets of borrowers and spenders. When we lend $100 out to somebody, we want $100 back. We don't want $95 back. If it's inflation of 5%, we only get $95 back in spending power. So inflation is a transfer of wealth from the people with money to the people with borrowed money. Always been that way, and that's the way it is now. So we're facing inflation if it does take off, which I think it'll be a while away yet, if ever at serious levels, is intentionally a transfer of wealth from the people with money, borrowers and the savers and lenders, which is us, to the borrowers and spenders of the world. The other way around, and I've got that here in one way, I'd actually say it the reverse. Lenders and savers favour deflation. The bankers of the world are always deflationary. That's what caused the deflation in the 1900s and late 1900s. What's caused the deflation in the Bretton Woods period? What caused the deflation in the 1840s? It's bankers trying to contain money and control money. And on the other side, spenders and borrowers favour inflation. So interest rates will rise. Central banks will probably need to react to. Central banks almost always go too late, too hard. So that because they're looking out of a rearview mirror, they're looking out of a truck after it's gone. So by the time they see something, it's already gone. Then they've got to make a decision, then they've got to talk about it, then they've got to publish it, then they've got to implement it, then they've got to see the results. Meanwhile, the next cycle's on. So it always reacts too late, too hard. Only one exception, which was Greenspan in '94, who reacted too early, too hard. It caused chaos. But they've learned from that. They will react. They'll let it go. And all central banks, including Owen, have said, Fed Powell has said, and even the RBA the other day in December said, we're going to let inflation run above for a while. And then they'll say, oh, mighty hell, we're going to go and crack down hard. So we're going to see 10 rate hikes, which is 10, 15 rate hikes is pretty normal for a cycle. Terrifying if you've got a mortgage of 2%. So they're talking about letting it go longer. So they're going to let it go longer. It's going to be out of the bag, and they're going to come down very hard, very late. And by the time they do that, the markets will have turned anyway in a recession, which is what the fear was in 2018. So it's just a way of processing the information and making decisions and seeing it work is very late and lots of lags in there. So that'll be a problem for cash. Bond returns are going to be negative or poor as yields rise. Corporate bonds are better. We favour corporate bonds, high-grade corporate bonds, because they've got lower terms and they've got higher yields. Bonds don't provide a buffer against shares and tell us to cover it when we have time. Shares do best. People say, oh, rate rises are bad. No, rate rises are good for shares as long as inflation is low or moderate. RBA started setting rates via the short-term cash rate in 1991, 92. Since that time, share market in Australia has done better in rate rise cycles than it has in rate cut cycles. So it's a bit of a myth about how interest rates work on shares. There'll be regular sell-offs and scares. That's the problem. It's going to be regular. We're going to say, oh, it's like we're going to have 10 rate hikes next year, and shares will sell off 30%, which they do every couple of years. We've seen a couple in the last 2 or 3 years. No time to panic because inflation is all a long way away yet. I think, by high inflation, I mean 5% plus inflation. Property, ungeared property is good. Low gearing on property is good. Quality. The problem with property is you've got to buy land. You've got to buy well-located land. Land goes up, buildings come down. That's why it's called depreciation, because it's worthless after 5 years. You've got to buy land in a well-located area. Sydney, Melbourne, Brisbane's a question mark. Nothing outside Sydney, Melbourne, close to the places you live in are good. People start talking about buying a high-rise airspace in the back of Darwin. That ain't property. That's airspace. Buy land close to a metro area like Sydney, Melbourne. High quality, and that's okay as long as it's not short-term debt, long-term debt, floating rate. I mean, I put a note out, I think, 6-ish months ago saying you'll never get a better time to lock in interest rates on fixed rate loans. One of the advisors came to me the other day and said, I've got a client we're thinking about fixing and locking in rates for 3 years at 1.5% or 5 years at 1.9% or 7 years at 2%. I said, anything under 5% is good. Look, I had an 18% advance bank mortgage in 1989. That's an incentive to pay it. All of you had 18% mortgages. That's an incentive to never borrow again. These kids have got 3% mortgages and they panic when it goes to 4%. It's going to 5 or 6%. Wake up. That's going to terrify a lot of people, and that'll affect share markets and all markets when they realise that the normal running rate, cash rate in the economy is around about 4 or 5%. Running at zero now, getting there is going to be 20-ish rate hikes, and it's going to be painful. So basically, property is good. Long-term property is good. Well located by land. Land content. Your house, you've got a house anywhere from the 15 k's around Sydney. 80% of the value is in the land. Doesn't matter what's on it. It's the land that gives you the value that's going to go up. Buildings will appreciate. It's called appreciate. I won't go that one. Question I got today, which is a good question. Why do we have bonds in portfolios? They're yielding 1%, 2%. Why do we have bonds? And the answer is, for the last 30 years, bonds have provided excellent buffer against almost all share sell-offs. So this is since 1980. The green bars are the share returns, and the blue bars are the bond returns. The ones I've highlighted are where shares sell off, bonds do well. Shares sell off, bonds do well. Shares, and this is going back to GFC, they're all back there. One exception was 94. I mentioned 94 with Greenspan acting too hard too early. Bonds and shares both sold off. But in every single case, 2 years running in the 70s, in the early 80s recession, bonds, great return. We're talking 6, 8, 10%, 13, 9. These are boring government bonds. They do soar in value whenever shares sell off. There's a trick in there. Most textbooks are written, I reckon, 30 years is a long time. I reckon 100 years is starting to get long enough to see what really goes on in all sorts of environments. So most textbooks say bonds are great because they do well when shares sell off. That's only because they've forgotten that inflation has been falling. The next 30 years going back is going back there. You see, what you see here, inflation's high or rising. This is the 60s and 70s. And guess what? Bonds sold off, shares sold off in every single case. Bonds provided no buffer at all once inflation is high or rising. So that's why we keep bonds in portfolios, because in the current low interest rate, low inflation environment, and it'll be low inflation for quite low bidding, below 5%, bonds provide an excellent buffer against share sell-offs, and still do. We're underweight bonds because we're worried about inflation, so we have less bonds than we should have in portfolios, and they're all high-grade bonds, and they're primarily corporate bonds, which have shorter duration. Apologies for that, but did you die? Interest rates, I will skip this. That basically says that shares have done better in recent decades when rates have been rising. Now think about why are central banks raising rates? They'll do it because they think the economy is running too hot, which is good for sales and revenues and profits. So it's self-enforcing. Now, it's when central banks act too hard, which they do when they act too late. They go too hard. By the time they do it, we're already in recession, and they prolong the recession. So it's a great timing mismatch between central bank policy and actual real life. So then people say, gold. Hands up those people who ask questions or receive questions about gold daily. Okay. You only ever get questions when it's going up. What does that tell you? It's gambling. If you get questions when it's going down, people say, I reckon gold's worth about 800 an ounce. It's now down to 700. Should I buy? I never get that question. Because they panic when it's going down. They've got no concept of what it is. I know what a strawberry is. I know what a melon is. It's got a value. It doesn't produce cash, but it's got a value. If it's above the value, I don't buy it. If it's below the value, I buy it. Gold. I've got a lot of gold. In my previous life, I built 2 gold refineries, one in Perth, one in PNG. Sold it to US gold refiners. I've got a lot of gold. This is my little short-term chart of gold. I'd start there because that's when Abe Lincoln took the US off the gold standard. Why? To print money to finance the Civil War. They're called greenbacks because they're not backed by gold. They're printed in green, they're paper. That's what they're called, greenbacks, and they've been called greenbacks ever since. The Great Deflation. So the point is here, gold. This is gold in US dollars, real US dollars. That's this is January 1980 when you get 850 ounces, which is about 3,000 in today's dollars. This is we can get all these charts. I might as well send it to you tomorrow if you want. Pure luck, I think. It's been 31 years for gold to recover after each spike. Why 31 years? Don't know. But it happens. It goes back further to Napoleon, by the way. But that's since I think 31 years is enough for somebody to forget the stupid things they did 31 years ago, and the kids do the same thing 31 years later. I think, but it is remarkable. That's US inflation rate. So it's good. I got a lot of gold, but you buy it when it's cheap. When's it cheap? 10 years ago. I got a lot of questions. I did a lot of work on gold again when I got a lot of calls over Christmas in 2011 when people started to say, oh, it's going to hit 1900 an ounce, which was then a record in nominal terms. And it's back. This is the money printing scare now. Now, pure luck, it happened to take 31 years from that spike to that spike. And it nearly got there. Now, where it'll go, I don't know. But the point is, I would only ever buy it if it's falling and falling. Otherwise, every time, by the way, every time it spikes, it's immediately followed by lower inflation. Spike there, lower inflation. So it's been a very poor predictor of future inflation. Why? Because people pay too much, so just jump on because it's going up. So I always say to people, there's lots of ways of buying gold. Don't buy it now in a bubble. Over the next 5 years, do some work, try and understand how you might buy gold. There's lots of different ways of doing it. For yourself, but you buy it when it's cheap. When no one mentions gold in the papers, that you know it's time to buy it. This, by the way, is gold this year, or last couple of years, 2020 and 21. Now, inflation fears started to occur in America and UK in August last year, and bond yields started to rise quite significantly from August last year, this is pre-COVID, this is still in lockdowns, but everyone thought, oh, maybe inflation's on the way with all the money printing. So from August last year, bond yields started to rise, and they're still rising. So you'd think that would be the time when gold starts to rise. It hasn't. Gold's been going down since then. It's when it peaked. That's the US election, that's the storming of the capital, which is an Armageddon. America's going to go buy gold instead. So gold's been going, we used gold very well in portfolios in 2018, jumped 10% in the sell-off. We didn't use gold last year, it's been falling last year. So we like gold, but it's got to be used very carefully in the wrong time. It's not inflation hedge. Bitcoin. How many questions about Bitcoin? Again, I'll get none tomorrow because it's fallen 20%. But when it's going up, you get a lot of questions about should I get into it? Well, what's the value of Bitcoin? Ask people, what's it worth? What do you reckon it's worth? What do you sell it for? Well, I don't know. Nothing. You're only buying it because it's going up because some other fool's going to take it off you. It's got no intrinsic value. Now, you could argue gold is the same, and you could argue US dollars is the same, but the paper's worth nothing. So we'll get to that point in a second. It only becomes popular until you know. If you start thinking about it because it's going up, you know you're not investing in gambling, which is good. Nothing wrong with that, but it's a gamble. So I've asked myself, this is the thing, is it the new US dollar? US dollar's dead, it's dying, money printing. Americans, but Trump, US history. The theory goes. So if it's got the characteristics of money, then maybe it is a money. So let's look. Limited supply, US dollars, yes. It's being deliberately based, but at least we know in 50 years' time it'll be there in some shape or form. It'll be inflated away by 1 or 2, 3% a year, but at least it'll have value of some sort. If I put it under a bed or bury it in the backyard and somebody finds it in 100 years or 1,000 years, Roman coins are still worth money. US dollars are still worth money. Look at gold. Gold, probably limited supply. That's one of the great strengths of gold. You can't invent gold. It's got gold mines producing not gold, but it's a very limited understood supply. Store of value, thousands of years, yes. Can it be used for exchange? Yes. You can use gold, small coins and things as exchange. Is it hard to forge? Yes. It's very easy to measure. Everything with gold coins and gold bullion is very easy to measure. Everyone can measure. Is it theft? The problem with dollars is if you lose it in the bus, no one's going to give you money. If you lose gold, it costs money to insure, it's expensive, and you can lose it. There's no government to go to and say, oh, I lost my gold, can you give me gold? So it doesn't have that. Same as dollars, same thing as dollars. Is it an Armageddon currency? We covered this in the podcast at probably 2 months length, but if banks are down, power's down, society's broken down, look at, imagine if Trump's mob got in, that going around, Europe's the same, it's tinderbox ready to explode. You want to have certain things in that bag you take with you, dollars is one. You take Bitcoin, you need power, you need networks for Bitcoin, so I don't know. Certainly dollars, certainly. So the point is, you look at Bitcoin, doesn't yet. You need computers and power and networks. You need exchanges and things. It's no good as an Armageddon currency. It's the same as that. If you go to 20% of all Bitcoin ever mined, and the 17 million of them have been lost or stolen. 20% of the entire currency has been lost or stolen. There's some famous cases about trying to get it back. It's quite hard to forge, but who knows? You can't. I mean, Tesla got a jump last week because Elon Musk tweeted a couple of tweets over a couple of days saying that Bitcoin is the new thing, just like you got under GameStop right at the top and everything collapsed. He offered that you could buy a Model 3 with the Bitcoin. Now, one Bitcoin is worth about a Model 3, which is about 50,000 US. So today you can buy a Model 3 with a Bitcoin. Actually, yesterday it dropped 20% last night. If I had Bitcoin, would I part with it to buy a car? No, because it's doubled in the last month. It's gone up tenfold in the last year. It could do the same again. So it's not something you can exchange. I wouldn't do that. Why would I give up the chance of tripling the money next week? It could triple next week. I don't know. I wouldn't use it to buy. If I had a Bitcoin and I know it's a bubble, I say, well, hang on, I can actually buy a real car for this. It's worth nothing. It's fluff. It's worth nothing. Why don't I use that for a car? At least it's a car. You can go somewhere. So it depends on how you view your value of your Bitcoin. Can you turn up the shop and buy bread with it and chips with it and a beer with it? Of course not. It's got too much speculative value. So the problem is, not yet, and who knows? The dollar. This is one of the great myths of the world. Is the dollar in decline? We've seen the Trump, we've seen the storming of the capital. Is this the end of the Americas as we know it? Is the dollar dead? Well, the dollar in a lot of ways died in August 1971 when Nixon took off the gold convertibility, took off the gold standard. That's 50 years ago, 50 and a bit years ago, and to this day, there's never been a good replacement. Everything's been tried to replace the dollar. All sorts of commodities and baskets in gold, and baskets of commodities, and all sorts of funny accounts in the Reserve Bank, in statutory reserve deposits, and all sorts of funny. This is the since 1971. The US dollar line is that black line. It's pretty much exactly the same as it was 50 years ago. It's fallen against the great emerging market, yen and Deutschmark after the war. It's risen against the pound, which is a weak currency, and it's risen against the Aussie, which is a weak currency. Risen against the renminbi until it sort of started industrialising. It's been strengthened against that. But basically, it's pretty much where it was 50 years ago, according to the other baskets of currencies. We've been trying. Yes, US has peaked probably in the Reagan years. It's now the biggest debtor in the world. China's the biggest creditor. So US as an engine has died. It's matured, peaked. But still, for the last century, the US dollar has been the global currency, and probably 30, 40 years' time, it still will be, despite all the effort. China would love to be, but they're going the other way. They're controlling it more. They're talking about freeing up capital, but they've actually, over the last 2 or 3 years in particular, made it a more closed economy and a more closed capital account, so it won't be the Chinese renminbi. Could be other things, but certainly US dollar will be around for a long, long time as a pretty stable, safe haven currency. Proof of that is what happened last year. People said, oh, the dollar's down 10% last year, it's going straight to nil. Again, are you speculating or are you talking about value? Last year, the role of the US dollar as a safe haven currency is when people panic about anything, COVID, anything. They dump stuff, they dump Australian assets, they dump everything around the world and they return to the US, so the dollar rises in a crisis. Always has, always will. So when all the soft things, the Aussie dollar and all the soft currencies and shares, that one there, tanked 30% in the COVID so that was there in February, March. The US dollar rose, as it always does, and as things recover, risk assets recover, including the Aussie dollar and shares recover, the dollar retreats. So that's done precisely what it has done for 100 years. It's nothing unusual. The fact that it's fallen 10% means it's just given back the 10% it gained in the sell-off. So it's doing exactly its role. Nothing's changed in that role. So the US dollar is here still doing its role. So I'm not particularly worried about the US dollar. The Aussie dollar, which is what our Aussie dollar is a commodity currency. The Aussie dollar here, this is the US, this is a commodities index, which is just a broad CRB commodities index, published data, going back to 1970, the black line. The green line is the Aussie dollar trade weighted index, which is the basket of currencies. The red line is against the US dollar. So you can see here, all the ups and downs, the Aussie dollar follows commodity prices. Has done, not forever, certainly has done since the 80s. As long as we're selling commodities in rate for foreign exchange, it'll be a commodity currency. This is the short-term picture here. This is just iron ore and gold with the great iron ore spike after the Brazilian closures. Again, dollar down, commodities down, dollar up, commodities up, dollar down, commodities down, dollar up, commodities up. So it just follows commodities. And that's all industrial commodities, lead, copper, silver, tin, everything. So basically the same trend, including oil. Basically industrial commodities are a bet on growth. Growth looks good, like it has since the last 6 months. Everything goes up and the dollar goes up with it. lot of links between the two. Because they're both bets on growth and bets on China. I will cover, this is another question I wanted to cover. Are we in a bubble? Basically, we're in a bubble because central banks have decided that everything is going to be expensive, so you can't, they're trying to make people take money out of the bank, which is working, and put it into things, anything, shares. The theory, the hope is they'll put it into businesses to employ people to build stuff. But in fact, they're just throwing it at Bitcoin and dollars and stuff and gold. So they're speculating with it. So, and even the RBA said, all central banks, but even the RBA, which is normally waits a month before they seem to be coughing and he pretends to have a brain of his own, he said, oh, we're not worried about asset bubbles, we just want to inflate everything. He actually said that a month ago. The good news is that globally, corporate profits, 20,000 companies in the world that are listed on stock markets, half of which are American, generated profits of about $2.9 trillion US dollars in 2019, which is about level there. Pre-COVID, peak year. In the COVID sell-off, everyone was crunched, pretty much everyone was crunched. A few retailers did well, but everyone was crunched. Profits dropped about 35%. That was the posted profits for 20,000 companies around the world, including Australia. So profits did get hammered. This was the expectation for this magical rebound this year, which we're now in. And I've tracked this about every couple of months, 2 or 3 months, I do a big report, literally company by company, stock by stock, these are the sectors. And so far, the good news is, as we expected, we'll overweight global shares, even though they're in a bubble. So far, we're actually going to be more than that. It's probably going to be 2.8 or 2, maybe even nearly, it's probably going to be the same sort of level of profit, even though we're still in lockdown. Whole of Europe's in lockdown still, Britain's in lockdown still. Companies are making profits. So it's a bit different to what people expected a year ago with the biggest recession since 1933, 31. So they're ahead of plan. In fact, that's deliberately the end of December, and it's actually probably it's slightly skewed towards the upside. We may well globally recover profits. Now, interesting thing about that chart is we all think about global shares as Apple, Facebook, Amazon. They are not featured here. Most of the money in the world is made by banks. And they've been hit hard. They were hit severely in the lockdowns, as you'd expect with bankruptcies. They'll only have a partial ticker, a little swoosh. Tech stocks have just gone from better to better. You have the Apples of the world, and Microsoft's primarily. Telcos, which is your Facebooks and Googles, are there, which have done very well. They were hit very little. So the idea is we go through every stock, about 300 stocks around the world, and say, well, is it effective or not? What does its swoosh look like? And is it achievable? And the answer is, in aggregate, that's actually quite achievable. And it's running ahead of its expectations, even though we're still in lockdown and vaccines still sort of don't work or haven't been rolled out. So that's good news. So forget the hype. Actual company profits are doing better than expected, and we're heading for a pretty good year, even though we're still in lockdown. Stock by stock. That's the US picture, and that's the J curve. Well, that's the swoosh. That's the dotted line is earnings per share. It's actually ahead of budget. That's actually predicted to be more than it was in 2019. That was a profit reduction during the year. And so far, it's better than ahead. So about 90% of the US stocks I cover did better than expected. 90% of stocks are doing better than we thought 3 months ago. That's the Australian picture. And again, all these charts are off the advisor. The Australian picture was already going down profit-wise before last year, hit savagely, mainly bank losses and oil and gas. But it's not going to recover to its level for a couple of years yet. But even so, looking at the profits, we're about 2/3 through profit reporting. In fact, we're about 2 days left in profit reporting season this half-year period for February. And I reckon probably 80–85% of companies are doing better than we thought 3 months ago, except oil and gas, they're basket cases, negative oil prices last year. So a couple of sectors which are very happy. You look at the banks, they're going to raise their dividends more quickly than we thought, and they're the main dividend payers in Australia. Iron ore companies are giving away money. So the macro picture is scary if you read the headline. If you actually look at it stock by stock, the picture's quite different and the shape's quite different. And in Australia, they're actually beating that line. So they're expensive in a lot of sectors, but they're basically doing better than everyone thought they would, so which is underpinning the share market rebound. So what's going to go wrong? Well, we've talked about some of these. Rate hikes, there's 100% certainty the Fed will make a mistake because they're looking in the rearview mirror. They can't possibly look out the front mirror. Greenspan did that in '94, hit a pothole straight away. So they're going to take a long time to think and wait and talk, and they're going to come down hard when they do, because they're going to have to, because it's be out of the bag. So you're going to see 10, 12, 15 rate hikes. Not this year, maybe starting to talk about it this year, but it's certainly not going to be 3 years of zero rates. Another big risk is double-dip recession. These new virus strains aren't contained. We have no idea. The doctor in Brisbane yesterday gave somebody 4 jabs in a row because he just couldn't count or something. It's in the papers. He gave 2 patients. One was 85-year-old or something. Killed it. But it's not out of the woodwork yet. There's lots to go on in that COVID story. But most countries are well into their first round of jabs. And there's about 5 different types of jabs out there. We don't know what they do. They're not tested. They're sort of guinea pigs here. So I think there's no harm in taking them, but who knows what's going to happen. And whether they'll work with Australians, does it work forever? Do you have to every 6 months? Don't know. Give it a whirl. That's the official line. Most of the great crashes in history, a lot of the great crashes, including 1929, including 1987, were triggered by regulatory attack on a hot sector. In 1929, it was a hot sector was utilities, Edison utilities, the electric utilities, and they tried, and Roosevelt, as Attorney General, tried to close them down and close the monopolies down in exactly the same way as Europe, California, and 40 other states, and Australia and Canada and the UK are trying to close down the monopoly of Facebook and Google and Microsoft. So that will take years to occur, but that is a common element. There's a hot stock. It's a common, same as 1907, the crash. It's a hot stock. The idea of regulatory attack is not the cause of it, but it could be the trigger that's causing all these stocks, which are expensive. People suddenly think, oh, hang on, we're not going to create another planet with 7 billion people to buy an Apple iPhone. Maybe they won't grow as fast, and maybe breaking up some of these companies. So that's it'll be a trigger, that regulatory attack on a hot sector, which is a common element throughout many crashes in history. The other thing that's a common element in lots of crashes, including 29 and 87, is this lack of trust in a fundamental building block. In the GFC, it was lack of trust in banks. Banks stopped lending to each other because they had no idea what was on their balance sheet. That was a loss of faith in what a bank's balance sheet. So banks stopped lending. Westpac and NAB had to go to the Fed to be bailed out. It was covered up, it was revealed about 5 years later, but every bank, even safe banks, had an illiquidity problem. This time around, it might be these hacking attacks. It might be a massive hacking attack on banks. Don't know. They can do it. They're probably just planning and waiting. In 2011, it was the fear of US default. Remember the downgrade crisis, the closing of the government, the shutdowns? That was a big sell-off in the US, and the only time the US dollar fell in a crisis since 1971. So this is a common element in, it's not the cause, but the trigger that causes a collapse in confidence. The Apples and Googles and Facebooks and the Amazon's trading at a P of below 100, which is good. It's on 74, I think, today, but it's normally above 100 now. It's a great company, but is it going to grow at the same rate it has in the last 30 years? No, it can't possibly grow at the same rate. So, same as Facebook, same as Microsoft, they're not growing at the rate. There's not enough people in the world, not enough planets to conquer quickly. Tesla's trying. So, we all know it's expensive. We're all not propped up by fake money printing by the central banks. A couple of triggers will be the events that occur. That could be a trigger out of the blue. It could be like a COVID attack, which was recovered quickly, only because they could print money and go into deficit. There's going to be a time when governments are unwilling to keep spending. So currently the government, the Australian government's got a lot of headroom to borrow, quite a low debt country, as we saw. But there will be a time when Britain or America or certainly Europe, parts of Europe, they'll lose their ability or political willingness to borrow, to keep spending. So that will be a bit of a wake-up call for people who think it's going to be free money forever. So the winding back of the job keeper, job seeker, Australia's doing quite a good job in containing that. But a lot of countries are letting it go and will have to suddenly clamp down because people won't lend to them anymore. So lack of faith. So these elements are quite common, recurring themes in what triggers a collapse. So there'll be a combination of some of those, and some of those are already bubbling. Good place to be in. Favourable demographics, which is one of the great predictables. Good thing with demographics is when someone's born, you know they're going to be 10 years old in about 10 years. Go to school. you know, they're going to leave school, they're going to reach high school probably something like 6 or 7 or 8 years later. They want to buy a car and a house. So demographics is one of the great predictables. There's things like wars and plagues that kill tens of millions, but beyond that, demographics is one of the great predictables. We know China will stop growing. The one-child policy 30 years ago, that was done. You cannot do that. Singapore, same. So you know the demographics. What changes, of course, is immigration. Australia's always been a very pro-immigration country. That'll kill Europe. No one wants to go to Europe. No one let them in. They'll be beaten up at the border. No one goes to Japan. You can't integrate to society. Japan is not an inviting country culture. Australia's always been, Australia, outside of Africa, Australia is the highest population growth country in the world for 100 years. Still is. Outside of Africa, apart from Israel, which is the case. Very likely the Cold War will be great. We'll see the odd hot war like Vietnam, Korea, or hot wars on the periphery. But we are seeing a serious build-up of military spending across the world, particularly in Asia. They're all built with rocks. Wars are people throwing rocks at each other, basically. What have we got? Rocks. So currently 80% of our iron ore goes to China. They could turn it off tomorrow. They've turned off coal, they've turned off beef and wine and everything else. They could turn off iron ore. They just need us too much to build their islands and their ships. They probably will scale it back. A bit of a change with Biden. And you can see Morrison's had to change his rhetoric a bit. He hasn't got his friend Trump in the White House. So you can see them, overnight, Biden's team had a bit of a jab at Morrison for a couple of things. One was coal, one was China. So whatever happens, we're going to have to get away from our heavy reliance on China. The good news is everyone else is spending. The whole of Asia, China's surrounded by 17 states which hate them. Every single one of those has got a military budget. A lot of those are supported by the US. Very positive for politics in Australia. Geopolitics, which is a bit of that there, we'll talk about all these countries. You know, India, Japan for the first time since the war, building ships, which is great. They were an enemy last time. Don't forget that China was an ally last time. Japan was the enemy last time. This time it's the reverse. So there's nothing ingrained or inherent in this. This is basically who suits the time. Government both. This is, I think, governments on both sides. I'm not being political, but governments on both sides have. We've got a great Australia. The 4 British colonies, Australia, US, Canada, New Zealand, are phenomenally well set up countries. Rule of law, property rights, freedom of speech, freedom of the media. You can't move on. But it's pretty much, compared to any other country in the world, it's 1,000% better as a place to live and operate. Pro-growth, pro-business, borrowing headroom, so that's pretty good. The only thing left we've got to worry about really is this is our exports by country since year dot. You know, we sold everything to Britain in the first 150 years. Britain left to go to there. We said thanks very much, goodbye. Japan took over as a major export customer. They bombed us there. Japan took over. Since the 2000-ish, China has taken over as they take 40%. It's now about 43% of all their exports. So that we've got to work out how to keep selling it. Now the Europeans basically said, shut up and take the money when they signed the trade deal a month ago. The Australian government's got to learn to either do the same or start making deals very quickly with other parts of Asia. Of course they're there and they're all buyers. So that's a tricky thing to negotiate when that's your enemy. Same way as US, the major creditor of US, the biggest owner of US government bonds was the lenders of the US. US is a borrower and spender. China is the biggest creditor, so the US has got to go to its banker and say, can I borrow money to buy ships to bomb you? That's exactly how it works. So that's going to be a very interesting way. Reagan started that when he lost the lead to Japan in the 1980s. So that's an interesting theme over the next couple of administrations as to how they manage to do that. Now, good thing is US will grow its way out of problems. China as well will grow its way out of problems. Meanwhile, Europe and Japan, who are becoming allies and could be powers in their own right. We haven't got China-US anymore. We've got China-US, Japan becoming more independent, and Europe now saying, hang on, I'm a third party here, so Europe's going to have to build up as well. And good luck. It'll be good to have 3 players, not just 2 players. So that's an interesting, that's the major dilemma for Australia. How do we manage that and keep prosperous through it? I think I've covered the current views. We're bullish on shares still, primarily global shares, emerging markets. We're underweight bonds with the fixed rate and inflation risk. We're overweight floating rate, high rate floating rate fixed interest. We have no cash, so we're not worried about the low cash rates. And portfolios are very diversified, and they're going to be there when you need it in 30, 40, 50 years' time. Meanwhile, you can go ahead and play with Bitcoin. That's not investing. On that note, I thank you very much, and I think it's time.
Thank you, Ashley. Exactly on schedule as always. I think I may be receiving some feedback. Now, we possibly have time for one or two quick questions.
Q&As. What haven't I covered?
Serious point, and I'll come to you, Rob. We are actually tonight, for the first time, trialing something new. We've been recording all of tonight's session on a YouTube, which is basically you'll have the slides on the screen and Ashley's narration over the top. So I'm quite conscious because of COVID rules and the tables at the back. You're a long way from the screen, and Ashley goes into extremes of details in some of the slides. So you'll actually have a high definition slide there with his commentary over the top that you'll be able to go back and watch, skip through if you feel any of the parts are maybe too detailed, but surely not. To the bit that you want to see, and you'll get all that information. So we'll be sharing that with you as well as PDF copies of the slide. Questions come for you, Rob. Yes. 2 seconds. We'll just quickly work my way.
I can hear you.
Actually, from an economist's point of view, with your risks into the future, what happens if next Tuesday a Chinese ship puts a missile into a Vietnamese, Taiwanese, or American frigate in the South China Sea?
What will happen immediately is there'll be a shock and things will happen. Gold will go up, oil will go up, and shares will tank 10% or something. And there's lots of examples. The start of all the wars is various missile strikes and intentional bombs being dropped. There are bound to be mistakes and errors. Well, they're bound to be not errors, but half mistakes, and they will be very short-term shocks. By and large, you've got to understand where I'm coming from here. The wars are good for markets, by and large, and that's been the case throughout history. Unless you are the invaded country and you're taken over, everything is confiscated, which happened. But by and large, wars are basically people throwing rocks at each other. Business does very well. In the Second World War in Australia, for example, there was plus control on shares and there was profit control on companies. All Australian companies had to limit their profits to 1939 levels. It wasn't to boost profits, it was to actually stop people making too much money. American companies made a lot of money in the First World War, a lot of money in the Second World War. Now I say it because 70 million people died, but putting a shareholder hat on, by and large, wars, conflict, spending, people throwing rocks at each other and realising that rock's there, they've got to build another rock, is very positive for markets. Now there are exceptions, it's very inflationary, so the bonds always sell off. So they often have, like the last couple of wars in Australia, the bond prices were limited and fixed, as they were in a lot of countries. But generally speaking, unless your country is invaded and assets are confiscated forever, you'll survive and do well. If you look at Japan after the war, which they were belligerent, they were the country that bombed half the world. America invaded, took over it, confiscated all assets, very quickly gave it back, and let them build businesses, and Japan's our greatest ally. So all through that, American companies and Australian companies, by and large, there are exceptions, did very well. So it will probably come as a mistake. Will it be? This is where it's quite the actual initial bomb and shock. There'll be one. It'll be Hungary or it'll be Russia. Someone will throw a bomb to get a seat. Russia will throw a bomb just to buy a seat at the table. And it's showing how it can do that. More interesting, and that'll be a sell-off, and that'll be reactive, and that'll come back in a week or two and back. The more interesting question is, will that lead to a more serious integrated conflict? Now, through the 50s to the 70s, 80s, you had periphery wars. Vietnam was a peripheral war. Contained, America lost that one. Korea was a peripheral war because the major parties weren't ready or able to fight each other full scale. America doesn't want a full-scale war on their turf. It's never had one apart from the Civil War. China's got it. So this is where Xi Jinping is being very interesting to watch. Mao Zedong and Deng Xiaoping, their aim was to basically recover from and get back global respect after being dominated by 8 foreign powers for 200 years. So their only goal was for China to stand up and be counted as an independent country, and that worked. They had no ambitions of invading, apart from Vietnam in 79, which they lost, by the way. China invaded. They had no ambitions for territorial expansion because they were coming from such the poorest country in the world for 200 years, whereas 1,000 years ago they were the richest country in the world. Mao Zedong and Deng Xiaoping's only goal was to get China back to be a respected partner in the world. That worked. Xi Jinping has deliberately taken that, mind you, starting from a very strong position. It's now a half-rich country, not the poorest country in the world, which was 50 years prior. He's now saying, well, we've got this standing now. I want to actually at least control or dominate my part of the world, which is much more expansionary than Mao or Deng were. So, and you can see this in the Belt and Road. You can see this in New Zealand. Australia's got to be worried because a lot of our neighbours, from Fiji, Cook Island, they're now basically Chinese ports. Increasingly, there's an island of PNG which they sold the other day, which is going to be built as a Chinese port, like 50 miles from Australia. So this is quite a different departure with China. Now, if I were Xi Jinping, I'd say, I've got to try and take advantage, I've got to try and force Biden's hand. What they could do is they could throw a bomb, China could start something, and if only to test what Biden will do. Biden's got to do one or two things. He's got to go in, defend Philippines or Vietnam or somebody, Taiwan most likely, and say, I will back Taiwan with the might and power of the US, and that's a full-scale land war. Xi Jinping will, if he does that, he'll do that just to see what Biden does, because Biden, the last thing he wants is 20 million Americans dead. He'll probably win the military war because we've got more warheads in China, but it's going to be, I don't think Biden will do it. Biden's got to back down and say, no, we'll allow you to do it, we'll do it like a Hong Kong, we'll hand it back, we'll have a treaty. That will basically empower Xi Jinping to do more. And Biden knows that, Americans know that. So it's going to be interesting. There'll be bombs dropped and everything thrown just as a test case, and there'll be mistakes made. Somebody will shoot down an aeroplane in airspace. But more interesting is whether America or China can think they can win a broader war, and whether they want to commit their people to going to a full war. That's going to be, and I suspect it'll be a Cold War like the 50s, 60s, and 70s. There'll be peripheral wars like India versus China on the border, which we had last year and last month as well. That'll be fought out in very contained terms, and there'll be a standoff, just like Vietnam was fought out in contained terms. So I think we're heading into a Cold War build-up period, 30, 40, 20, 30 years perhaps, while China becomes much stronger and builds power quietly rather than taking over. The exception is going to be Taiwan. Xi Jinping's already said, I am going to invade Taiwan. And he might do it this year, and he might do it next year, but certainly that's the next cab off the rank. And he will test the US as to whether the US will defend or allow it. And that will define the next 20, 30 years. So short-term answer is, it'll be a shock. Everything will sell off, but it'll be back in a week or two.
Thank you, Ashley. That's probably a podcast in itself. I think we might leave it there, and have a wonderful evening, everyone. And Ashley's here to be able to take any more questions. Thank you for coming. Stay good.